Hello class, this is Dr. Carl Letamendi, and this is the video lecture for Chapter 4 for Fin 1100, and the chapter is titled Evaluating Choices, Time, Risk, and Value. Evaluating choices, time, risk, and value. Financial decisions can only be made about the future, which cannot be known with certainty. So evaluating alternatives for financial decisions always involves speculation on both the kind of result and the value of the result that will occur. It also involves understanding and measuring the risks or uncertainties that time presents and the opportunity cost that time creates. So you'll see if you take your studies into finance a little further that this word speculation plays a really big key role. As I've explained in previous video lectures, accounting is all about explaining what's happened in the past, and finance is about understanding or predicting rather what's going to happen into the future. So speculation plays a big role there. The learning objectives of this chapter are to explain the value of liquidity, demonstrate how time creates distance, risk, and opportunity cost, demonstrate how time affects liquidity, and discuss how time affects value. So in the time value of money, you have liquid wealth here. You have time, which is an element, and then you have not so liquid wealth. And then in the mix, you also have transaction costs, opportunity costs, and risk. Whenever we see liquid wealth, we're referring to the present value. And then you have the element of time between present value and future value, which is not so liquid wealth. Liquidity has value because it enables choice. Time creates distance or delay from liquidity. Distance or delay creates risk and opportunity costs. Time affects value by creating distance, risk, and opportunity costs, and time discounts value. So just going back here to this slide for a second, if you presently have a wallet full of money, for example, or a jar full of cash at home, that's liquid wealth. It's something that you have on hand right now, today. That's cash. It has a present value. If you have a home, however, that also has value, but it's not something that you can liquidate right away. So if you decide today that you want to sell your house today, chances are you're not going to sell your house today and get the cash in your pocket today. So that's, whenever you're looking at future value and valuation, that's what kind of like the example that's referring to. Some more learning objectives. Identify the factors you need to know to relate a present value to a future value. Write the algebraic expression for the relationship between present and future value. Discuss the use of the algebraic expression in evaluating the relationship between present value and future values. Explain the importance of understanding the relationships among the factors that affect future value. To do the math, you need to know what the future cash flows will be, when the future cash flows will be, and the rate at which time affects value. So for example, the cost per time period or the magnitude, the size or amount of the effect of time on value. So now we're going to get into a little bit of formula here. Don't let it confuse you. It's actually very easy. Just generalize the math. PV is your value today or your present value. So then PV is just this, right? R is the rate at which time affects value or the discount rate. In this case, your interest rate. So then R is rate. And if T is the number of time periods between you and your future liquidity, so then T is time. Then FV, is the future value of your wealth. So then I know in all these letters and symbols here, what is this telling you? Present value, rate, time, and future value. That's it. So don't let it all, this unfamiliarity with this formula confuse you. Since PV times 1 plus the rate times time is equal to the future value, then the inverse would be the present value is equal to the future value divided by 1 plus the rate and time times time. So that's just an inverse. If you ever move forward with studies in finance, and you have to solve for present value or for future value, you will get the future value or the present value. So you'll get present value to calculate future value or future value to calculate present value. But you'll have everything you need to solve the problem. Okay. Um, Present value times 1 plus rate and times time periods is the future value, and then the inverse, as we said, the present value is equal to the future value divided by 1 plus the rate multiplied by the time periods. As t increases, so then that's this, the present value of your future liquidity decreases. As the time period increases, the present value of your future liquidity decreases. As t or time decreases, the present value of your future liquidity, or FV, increases. As the future value increases, the present value of your future liquidity increases. As future value decreases, the present value of your future liquidity decreases. As the discount rate, or R, just think of R as rate, and don't let this discount word confuse you. It could mean interest rate, discount rate when you're talking about bonds and things like that, but it's just rate, okay? As the rate increases, the present value of your future liquidity decreases. As the rate increases, the present value of your future liquidity increases. So these are kind of like just general rules for when looking at this kind of formula for present value and future value. But there's some instances where things are not necessarily constant, and there's certain variables that influence present value and future value. So if we can think about cars, for example, your car has a present value, and you know that as time progresses, that car is going to be worth less. It might not be the case in other countries, where I know in some Central American countries, it's perceived that the older a pickup truck, for example, the more reliable it is because it has been reliable all that time. So there's that inverse relationship. So then there's also real estate. It is assumed that as time progresses that the value of your home will increase, but that's not necessarily etched in stone because there's other factors that influence the value of your home. So again, these are just general rules for solving for these, but present value, future value depends on what? It depends on many different variables. Calculating the relationship of time and value. Have liquidity, get paid, or have positive cash flow sooner rather than later, and give up liquidity, pay out, or have negative cash flow later rather than sooner. Or as Popeye's pal Wimpy used to say, I'll give you 50 cents tomorrow for a hamburger today. So, bad example given by the textbook. Okay, time value. Key takeaways. To relate a present liquid value to future value, you need to know what the present value is or the future value. So as I said, you're going to have one or the other to solve. You just need to know the structure of the formula. You need to know when the future value will be and the rate at which time affects value, the cost per time period, or the magnitude of the effect of time on value. You also need to know the relationship of the present value, the future value, risk and opportunity cost, the discount rate or just rate, and time, which may be expressed as present value times 1 plus the rate multiplied by the time periods. which equals future value. This equation yields valuable insights into these relationships. The more time creates distance from liquidity, the more time affects value. So meaning the more time you add between present value and future value. The greater the rate at which time affects value are, or the greater the opportunity cost and risk, the more time affects value. The closer the liquidity, the less time affects value, and the less the opportunity cost and or risk, the less the value is affected. And to maximize value, get paid sooner and pay later, which is not entirely true every single time, but generally yes. Valuing a series of cash flows. Learning objectives. Discuss the importance of the idea of time value of money in financial decisions. Define the present value of a series of cash flows. Define annuity. Identify the factors you need to know to calculate the value of an annuity. Discuss the relationships of those factors to the annuity's value. And define perpetuity. The present value of the series of cash flows is equal to the sum of the present value of each cash flow. So valuation is straightforward. Find the present value of each cash flow and then add them up. When there are regular payments at regular intervals and each payment is the same amount, the series of cash flows is an annuity. So just think annu as per annum or in a year. So ANNU basically means per year, like annuity. To do the math, you need to know what the future cash flows will be, when the future cash flows will be, and the rate at which time affects value. For example, the cost per time period, or the magnitude, the size, or amount of the effect of time on value. So to valuing a series of cash flows, to do the math, you have to know the amount of the cash flows, CF, the frequency of the cash flow, so like how often it pays, monthly, annually, semi-annually, etc., which is called compounding, but I don't know if this class will cover that. The number of cash flows, T, and the rate at which time affects value, R. To generalize in math, if CF is the amount of the regular cash flow, T is the number of time periods that you receive a cash flow, and R is the rate at which time affects value or discount rate, your interest rate or opportunity cost, then PV is your present value today or your present value, and then here we go. So then the present value of a cash flow equals CF, which is the amount of the regular cash flow, times 1 minus, and then in parentheses you have this to do first within the brackets, 1 divided by, and then 1 plus the rate times the time period, and then when you solve for this here, you divide it by the rate. It's a good idea to write down these formulas, so if you have to go back and solve any of these, you can just plug in whichever parts of the formula you're given in any problem that you're assigned, and then that way it'll become a lot easier to solve. Okay, if present value equals cash flow times 1 minus 1 divided by 1 plus R T divided by rate, and the future value equals the present value times 1 plus R and then time period, then the future value, so now we're looking at the future value of a cash flow, right? CF times, and then here we have the specific for the cash flow. You do this first, 1 plus R T, and then 1 divided by that, 1 minus that, all divided by R, times 1 plus R time, and future value equals CF times, and then in brackets we do this first, 1 plus RT minus 1 divided by R. So don't let any of this jumble up. I mean, basically the bottom line is this is the formula for future value, and then going back, this is the formula for present value, and that's it. So don't let all this confuse you, because it's just, it's just jargon in my opinion. Okay, since the present value is this, as t increases, or time, the present value of your future liquidity increases. As time decreases, the present value of your future liquidity decreases. Because t is the number of cash flows as well as the number of periods. And then basically is if t increases, so then there's higher number of time periods, then your present value increases because there's more payment. So it's more liquid than decreasing the amount of time periods. So think of it this way. Think of it like a savings account, just like a regular savings account that you put money into. If you, hypothetically speaking, if you got paid interest on that savings account every week, you would have cash at the end of every week, right? But if it pays out only once a year, you have to wait a whole year to see any cash at all. So that's what this is referring to. As CF increases, the present value of your future liquidity increases. Same example, same thing. As CF decreases, the present value of your future liquidity decreases. As the rate increases, the present value of your future liquidity decreases. As the rate decreases, the present value of your future liquidity increases. So some common financial annuities or assets are retirement savings, investment clubs, Christmas club savings, and bond investments. Bonds are usually they usually go by year. Some of the bonds will pay you what's called coupon payments, and these are basically like dividends for bonds, and they get sold to you at a discount. And basically, as you hold the bond, they'll pay you back for the amount of money that the bond is worth, plus an extra 5 or 10% or whatever. And you can buy city bonds, treasury bonds, and all kinds of bonds. So that's a type of investment that's kind of like the safest, I want to say, because it doesn't necessarily have the element of such a volatile and speculative stock market, for example. Unless, of course, the bond issuer also has stocks out there and relies on those stocks to value the bond. Some common financial annuities or liabilities include mortgages, car loans, student loans, and consumer loans. Very wordy slide here. Valuing a series of cash flows, key takeaways. The idea of the time value of money is fundamental to financial decisions. The present value of the series of cash flows is equal to the sum of the present value of each cash flow. A series of cash flows is an annuity when there are regular payments at regular intervals and each payment is the same amount. To calculate the present value of an annuity, you need to know the amount of the cash flow, the frequency of the cash flow, the number of cash flows, and the discount rate. Or just remember, as I said, just disregard this word because it'll throw you off, the rate, or the rate at which time affects value. The calculation for the present value of an annuity yields valuable insights. The more time, the more periods, and the more periodic payments, that is, the more cash flows, so the more liquidity and the more value. So remember, like I gave you that example with the savings account. Same holds true here. For example, like if you have an apartment that you rent out, you're not gonna You're not going to ask your tenant to pay you at the end of the year. You're going to ask for monthly payments. So you can anticipate as that property owner that at the end of every month you're going to have a constant cash flow because they're going to pay you every month, right? And you'll increase your liquidity even a step further if you ask your tenant to pay you weekly instead of monthly, and even further if you ask them to pay you daily instead of weekly. But of course, you know, aside from hotels, what I haven't seen anybody pay rent on a daily basis. The greater the cash flows, the more liquidity and the more value. The greater the rate at which time affects value. The greater the opportunity cost and risk, or the greater the rate of discounting, the more time affects value. The calculation for the future value of an annuity yields valuable insights. The more time, the more periods, and the more periodic payments. That is, the more cash flows, so the more liquidity and the more value. The greater the cash flows, the more liquidity and the more value. The greater the rate at which time affects value are, or the greater the rate of compounding, the more time affects value. And a perpetuity is an infinite annuity. Perpetual makes sense. Evaluating financial choices, learning objectives, define pro forma financial statements, explain how pro forma financial statements can be used to project future scenarios for the planning process. Pro forma statements, you got income statement, cash flow statement, and then balance sheets. Can play out the possible scenarios. Pro forma financial statements show the consequences of financial choices in the context of financial statements. Explain the basic dynamics of probabilities. These are some learning objectives of evaluating risk. Discuss how probabilities can be used to measure expected value. Describe how probabilities can be used in financial projections. Compare expected outcomes of financial choices. Evaluating risk. Choice is deliberate. Chance is an independent event. So as an example, let's say you have a coin toss. The coin toss is the independent event because you deliberately choose to flip a coin, but you have no control over the chance. The expected value equals the probability that you'll get heads times the result of heads plus the probability that you'll get tails times the result of tails. Given that the probability of heads plus the probability of tails equals 100%. So basically, let's say that this is telling you to flip a coin 500 times. Right? You'll get the result of heads, right? So then probability of heads times the result, probability of tails times the result of tails. Same situation. The expected value is the weighted average outcome of all possible outcomes. So this is just expected value here equals the sum of the probability of n times the result of n. Well, the n is the number of total outcomes. So the probability of any given outcome, and then the result of the number of possible outcomes. Expected value can be used to evaluate and compare choices that involve chances. Probabilities can be used in financial decisions to measure the expected results of an independent event. The expected value for a choice may be figured as expected value equals the sum, and then in parentheses, you do this part first. The probability times the result. And then it would be the sum of that. Expected value can be weighted against or compared to the values of other choices. And that concludes chapter 4. Basically, when you're just going back here to the slides on probability, there's a lot of other things that go into this also. So, like for example, if you're trying to predict, subsequent cash flows, for example, given a certain situation, you want to look at historically what's happened so far to determine your projections, not just base it on the probability on this type of probability formula, because you're not really just using it alone will not really tell you anything. So then this is kind of like the prequel to the regression formula, which gives you insights into what sort of predictors um, are strongly correlated with your outcome. And that gets into a little bit more of predictive statistics and inferential statistics, but I don't believe we're going to be covering that in this class in particular. But that's just something to keep in mind, that whenever you're forecasting, you have to look at what your revenue stream has been like historically, and you also want to account for the unforeseen circumstances that may take place. So this applies whether you are somebody who manages money for an organization or a corporation, and also in your own personal life. When you're managing your own money, you also want to account for the frequency of unforeseen circumstances in predicting future revenue streams. This concludes Chapter 4 video lecture. If you have any questions, comments, or concerns, as always, please feel free to contact me and I'll be more than happy to assist. Thanks and have a great day.